Good evening. My name is Sikin Kabateli. On Moneyline this evening, we take a look at some of the stories that we featured as part of our Investing 101 shows. Now, every day, our business anchor, Arabile Gumede, brings you the market indicators. For the uninitiated, the list of numbers and arrows often appears meaningless. So we asked Arabile to explain these further for us.
The bulls and the bears, the ups and the downs, sideways trade, choppy movement, and the greenback. This is just some of the financial jargon that twists the tongue and confuses the ear. But all these facts and numbers do actually mean something and have a significance for both you and I. The Johannesburg Stock Exchange is Africa's biggest. It's where firms list their businesses in order to raise money and grow the company.
The Johannesburg Stock Exchange itself does not have the capital. The capital comes from the investors. Now, the investors can be individuals, the ordinary people in the streets, and other institutional investors as companies.
Each day, investors buy or sell shares in over 360 companies. This activity determines the price of the share according to supply and demand. So basically, the more people believe in your company and its potential to give them interest, the higher the share price goes.
The all-share index and the numbers that are always said, like 51,000, does not necessarily mean much. In short, what it means is to give an indication of whether the market had improved from the day before or has it gone down.
Commodities are the collective name for resources extracted from beneath the Earth's surface. These are also traded on the JSE. The US dollar is considered the most common international unit of measure, so prices of resources such as gold, platinum, and oil are all measured with the US dollar. Changes in the prices of resources are also determined by supply and demand. Gold, oil, and platinum may be the most traded metals across the world, but simple resources like copper, iron ore, and nickel are also traded on the local exchange. Agricultural products from coffee to soybeans, maize, rice, and sugar all have a daily price. The bottom line is, if you can mine it or farm it, you can trade it.
All currencies are driven by news, global events that are happening. So you take an example like the geopolitical risks, where you've had the threat of war in the places like Syria, Russia, and the Ukraine. Typically, those types of scenarios will see investors, even the market, just look for risk-free assets. Typically, those are things like your US Treasury bonds, which are seen as risk-free assets. That creates demand for dollars in the market to actually buy those assets, since they are dollar-denominated assets, and consequently, you'd see something like a South African rand weaken, and or other emerging markets as well.
Currencies help us measure our country's relative economic strength compared to other countries, so in theory, the South African rand could be weak against the US dollar and strong against the euro. The movement of the Johannesburg Stock Exchange and all its indices, the commodities such as gold, platinum, and oil, and the currencies are all based on who wants what and at what time and price. The level of confidence shown by investors remains key to the demand. It can raise or drop the price of any item, indicating positive or negative trading. Investors put their money into company shares, commodities, and currencies in order to make a profit. So if you want to start trading, make sure you get the right advice and, as well, a healthy dose of good luck.
Earlier this year, I spoke to Maudi Linzwane of Lihumo Capital on how one can go about creating a successful investment portfolio. I started by asking him how you can start creating a portfolio.
It's one of the most crucial, aspects of investing, and I think even though it's so highly important, it's still one of those highly neglected by many investors. And it's not difficult at all, to try and structure a very nice portfolio of investment that you can actually look back a couple of years later, and you've made quite a decent returns on it. So, effectively, how one needs to start in the beginning, it's very simple. It's to try and build an asset allocation, a criteria that is best suited to you as an investor. So what is suitable for Siki will not necessarily be suitable for Maori. And, so you've got to understand precisely what your individual needs are and what your plans are, for the future. How much capital you're going to need in the future for whatever reasons that you're going to need that. And also another aspect, which is quite crucial, it's your risk tolerance as an investor. So I might be of a higher risk, I might be able to tolerate a slightly higher risk as opposed to Siki. So it's very important that each and every single person does the analysis on themselves to try and ascertain exactly what type of asset allocation is then going to be needed for them.
Okay, so we talked about diversifying, right? Making sure that you don't put all your eggs in one basket. So what are the key elements in any good portfolio?
I think, as part of the diversification, which is crucial, you've got to make sure that you've got exposure into at least, a couple of all the other, asset classes. I mentioned equity. You can't take all your money and put them into shares. You've got to have, exposure into equity markets and also have a little bit of exposure into the fixed income markets, which is the bonds. And it's very easy to actually buy bonds for retailers, via retail savings bonds, which are all there in very easy access. And, and also a certain portion needs to go into cash, money market. So a lot of mistakes that we make is that we think we've invested good enough and we've put all the money into fixed deposit.
One asset class.
That's the problem. So diversification is a bigger, it's one of the important aspects to that. Making sure that even within the equity market, you cannot buy into one sector, for instance. There's multiple sectors that you can actually diversify into as well. So take a portion, put it into the resources space, a certain portion, put it into the financials, industrials, as part of your diversification plan. That will ensure that ultimately, in the end, you are able to achieve good performance.
And the buying and the selling, how often should one do that? How often should you dip in and out of your portfolio?
You should never really, try and trade your portfolio. If it's an investment, you are there for a long haul. So you're going to, assess it and have a look at it periodically, but not on a daily basis. I think the best, a period to really have a look at your portfolio is probably to have a look at it and reassess it after a couple of, after 3 months. Have a look at it. And it's the most important part, of course. The decisions that you made 3 months ago could have changed.
Yes.
Not only with respect to the shares that you've invested in, but also your personal circumstance might have changed. Your risk tolerance also might have changed. That 3 months later you are willing and able to take on a slightly higher risk.
Yeah, and there's also the danger of just falling in love with your portfolio. So even if a particular share that you love continues to do badly, you just convince yourself, things are going to change. Absolutely. It's going to get better. How do you know when it's a good time to just say, you know what, cut my losses, let's move on?
I think, research, it's done. You might not be, as a private individual, to actually be able to unpack that a company will do a bit of a due diligence on the company, but that's where you need the relationship with a reputable broker.
Of all the precious metals, gold remains a popular investment. Throughout history, gold has been used as a medium of exchange and viewed as safe and reliable. But why is this, and is it still true today? Well, I went to find out. Thousands of men and women in South Africa go into the belly of the earth to dig for gold. South Africa is home to 8 of the 10 deepest gold mines in the world. We are currently in the 2nd deepest mine in the world. The country's wealth was built on this precious metal along with diamonds. Digging for it is not for the faint of heart. Safety concerns are crucial at our mines. A lot of time is spent underground reinforcing tunnels and making it safe for the miners to do their work.
They would move into the working environment, or the stope as we call it. The entire crew would then sort of have allotted areas, to actually examine, make safe. And they do this with certain equipment. We call it barring equipment, which really is steel pinch bars. If you've seen it like the olden days with particular gaskets, they would then make the hanging wall safe. And once that is done, the actual team would then together as a unit declare the area safe to work.
But how did this piece of shiny yellow rock become so valuable? Gold is respected throughout the world for its value and rich history. Even in ancient Egypt, gold was a store of value.
Around about 800 BC is when gold first came into play as a medium of exchange. And King Croesus, around about 500 years later, about 300 BC, was the first person to strike a gold coin. So gold coins as currency, as a medium of exchange, have been with us since Croesus and plus or minus 300 BC.
Gold was also used as the world reserve currency for most of the 20th century. The United States used the gold standard until 1971, when President Nixon discontinued it. Paper currency really came into being quite late.
Remember that the first banknotes said, "I promise to pay the bearer in gold." It didn't say, "I promise to pay the bearer 1 rand or 100 rand. He said, "I promise to pay the bearer 100 rand in gold."
Despite its price fluctuations over the decades, gold has been an enduring store of value for centuries. But why do people still invest in gold today?
Primarily, gold is viewed as the asset of last resort. In other words, if you want the ultimate safety, you buy gold. Other than that, you buy paper, whether it's bonds, whether it's currencies, whether it's shares in the market. The moment that trouble starts and people feel uncertain about the future or unhappy about the way their country is operating, then the move goes towards gold.
To this day, gold is seen as a hedge against inflation. People invest in it in times of uncertainty or when they feel they need a secure place to keep their wealth. Sikim Gabadeli, Johannesburg. After the break, we take a look at what moves the rand and how to invest your rands. You're watching ENCA Moneyline, your money guide. Stay with us.